Hey everyone, thank you for joining us. 2020 has been a very interesting year so far. We have a lot to talk about today, so hopefully you're ready and we have things we want to discuss with you. Some issues are ongoing. We've got an election coming up. We have obviously still COVID is still here. We're not sure for how long, hopefully not too much longer. But yes, Mike, give us some good.
No, but you're right. 2020 is a heck of a year, right? This coronavirus chaos, the stock market chaos, even weather this year happening, right? I mean, we've got unprecedented fires. Remember the double hurricanes that were about to run you over down there in Texas? I would say that was a 100-year event kind of a thing. It really has been incredible. But as Tana said, we wanted to kind of touch on some things. There's been a lot of anxiety, I think, creeping up with the political elections, what the impact of those could be for yourselves and everything that we do here. And so we're going to talk about that. We're going to talk a little bit about the politics, what to expect from the election, certainly how that might impact your individual plans. Now, we are sending this out to just our existing client database. This is an on-demand webinar. So feel free, if you think the content is useful, interesting, valuable, feel free to forward it to your friends if you'd like anybody to listen to it. And then certainly I am open for objection, opinion. There's going to be a lot of, we'll say, conjecture in here of me expressing how I feel about things. So please don't hesitate to give us any feedback or any thought you're having. But hey, first and foremost, Tana is going to give us probably a 20-minute dissertation on how the Electoral College works.
No, that'd be so boring.
I'm going to make some popcorn and just sit here quietly. Look, Electoral College, for most people, totally confusing, right? It's, why don't we use a popular vote? Why do we do this? Why do we do that? It doesn't really matter. It is what it is, right? These are the rules. I find, it's funny. They assign electoral votes per state kind of based on population size, but then it gets weirder because states like Maine and Nebraska, they can split their votes, and it's kooky. In simple math, I just pulled this off of Real Clear Politics a couple of weeks ago. In simple math, quiz question, Tana, how many Electoral College votes do you need to become the next president?
Ooh, I would say 210.
270. But
270.
Hey, look, we're not historians here, whoever follows this hubbub. So this is the last map. You notice there's some gray states. Those are considered toss-up. There's things leaning red, things leaning blue. You can kind of see the numbers at the top of the screen. Tana and I are not here to be election prognosticators. We don't know who's going to win. We don't know what's going to happen. If I learned anything in 2016 about polls and data, is it's all kind of a waste of our time until it's all said and done. And so, right now, I'd say that at least based on the map, if our goal is 270, things are leaning blue. But hey, like I said, I don't trust any information at this stage of the game. We've still got, the better part of a couple months to get through to figure out this mess. But once again, who the next president is, how is that going to impact you? How is that going to impact legislation and impact the stock market, right? Those are the things that we're all thinking about. So here's what we did. So one of the things that we did is kind of as a data gathering experience, Tana went and I went and we pulled all of the election years for the last 100 years, basically, back to 1928. And in that time period, there was 23 elections that have happened since 1928. This year will be the 24th. And so we've got a lot of years, a lot of data. On the right side of this column of all the years, you can kind of see Republican, Democrat, Republican. Over time, it's always switching back and forth, right? So one way or another, parties are always changing. People will argue now that, oh, but this year is scarier. This year's more confusing. It's messier. But granted, let's be fair. There was a lot of years in the last 100 years where people felt that way about people coming in. When I was a kid, actually not when I was a kid, when I had kids, I said to my mom one time, I remember saying, gosh, how are we going to raise our kids in society these days? It's so scary out there. And you know what she said, Tana? Any guesses?
Well,
no guesses. Okay.
Well, I'm just thinking that I would just say, it always just works out.
Well, there's that, but she said, I felt the same way. She felt the same way. That back when she was raising us, oh my gosh, look at all the changes, look at the confusing, things could never be worse. How are my children ever going to survive? And that's just how society evolves and continues to progress. But when we look at this data, remember, my job and Tana's job with all of you is to help you understand the unemotional side of this. What is the statistics? What is the math? What is the data and the relevance on these cycles? And so when we look at the last 23 elections, guess what? Most of them are positive. 19 out of 23 election years were positive years in the stock market. That's 70% of the time. Now, it's kind of interesting because if we were playing the ponies and I said, hey, I got a pony that wins 70% of the time, you'd say, well, it's probably better to bet on that than not, just because there's a reasonable probability that that would play out in your favor. But granted, we won't know until after the fact. Now, what's interesting about this chart, though, as we were looking at it, is I felt that there were some outliers. Because remember, in the last 100 years here, we have 4 negative years. Well, one of those negative years was 2000. Tana, do you remember what was happening in 2000 by any chance?
.com crisis.
That's right? You couldn't go to pets.com anymore and buy your food online. Now you got to go to Chewy. Isn't it funny how things evolve over the years? But yeah, so back in the 2000s, it was the .com crisis. The market, in my opinion, was already in a recessionary freefall. The fact that it was down that year had nothing to do with the election. It already had problems. So it's hard to use this as a statistical indicator of, oh yeah, see, when it switches, it's negative year. What about 2008, Tana? What was going on in 2008?
Banks over leveraging their loans, and so just imploded. It was a big mess. Great Depression.
The Great Recession, right? A handful of hundreds of banks went out of business. Millions of people lost their homes. The stock market was already in a free-for-all before President Obama came into office. So it's hard to say, oh, look, we have a negative year predicated on an election year. So I hear it all the time. Every time this happens. Back in 2008, I had my conservative clients say, hey, if Obama wins, he's going to ruin the stock market. I'm selling everything to cash. I'm moving to Canada. Well, guess what happened when Trump came in? All of my liberal clients said what they say. Oh, Trump's going to ruin the stock market. I'm selling everything to cash and moving to Canada. Now, what's funny about that is I know plenty of people that sold to cash. I don't actually know anybody that moved to Canada. And in both scenarios, selling to cash was a pretty major mistake on hindsight. You have to realize policy takes time to develop. President Trump, for example, he was elected in 2016. He passed reforms in taxes, the Tax Cut Jobs Act, in 2017. It didn't go into law until 2018. So just because someone becomes president, you have to look at how long it takes them based on their proposals to even get something done. So the moment of someone winning presidency doesn't automatically equate to this just free-for-all in the stock market. And if I was to discount years 2000 and 2008 on this chart, guess what? More than 80% of the time, election years are positive years in the stock market.
That's a good point.
So that's something to think about. This graph is a little hazy. I pulled it off of a data feed, but I thought it was very interesting. What do we think about when we think about Republicans? Commonly, we think they're kind of business friendly, right? And we think that if a business friendly group of people would inherently lead to automatically higher stock market returns. Now, what you would think, Tana?
Yeah, that's fair.
Maybe not. I don't know. So look at this. I put a red box around it. This shows if there's a Republican president, and then depending on the control of Congress, is it Republican controlled, is it Democrat controlled, or is it a split Congress? It shows the average stock market returns based on those cycles, basically in the last 100 years. I find that interesting because then when you compare it to the right side, the blue square, and you look at Democratic presidents, whether Democratic-controlled Congress, Republican-controlled Congress, or a split Congress, actually, historically, Democrats have higher average stock market returns. Now, you'll also notice that in both squares, the right side, Republican split and Democratic split, Guess what? Stock market likes split Congress. They like uncertainty. The stock market wants to know big sweeping regulations and taxes. Things don't get changed quickly. But it is an interesting fact because a lot of us in our minds, we would connotate the Republican control as being those higher returns, whereas in the last 100 years, it's really the Democratic control. Now, there's a lot of thesis behind this. People will say, well, it's the snowball effect. The previous administration created regulation that impacted the proceeding. They could say it was the new people that came in. There's a lot of conjecture on what makes sense. Well, let's be fair. Businesses adapt, right? They adapt to political cycles. The business cycle never perfectly correlates with presidential elections. It's just like what I was saying with President Trump. It took him 2 years to actually get tax reform running in the system. So just because he was elected, that didn't automatically mean that would happen. So to be a betting pony on the, oh, that will happen, it's not done until it's a done deal. So business cycles aren't always working with presidential cycles. Yeah. Split Congress by default is always a positive thing when it comes to the stock market. Once again, that creates less uncertainty. The stock market knows that with gridlock, less will get done, which is generally a positive. All right, Tana, this is going to be a tough question. I hope you had your ginkgo biloba today or whatever. Which way is the green arrow going up? Is it going up or down? I guess I asked that question.
Yeah. You gave me the answer.
I gave you the answer. Which way is the arrow going? Which way is the up arrow going? That's a terrible question, and it failed yet again. So look, we pulled up this chart, and what we did is we banded the stock market over the last 100 years. We banded it based on blue and red. Who was in charge, who the presidents were, and what do we all notice? Tana just said it. One way or another, it doesn't matter if you're Democrat or Republican. It doesn't matter what color your undies are that won't tell anybody about. It doesn't really matter. One way or another, in the end, the stock market tends to grind higher. Now, granted, we can make a lot of different arguments with underlying policy. For example, Bush 2, he got sandwiched in between two major recessions, the dot-com and the financial crisis. So his era of stock market was less favorable compared to an Obama or Trump, who had essentially a tailwind off of the Bush 2 issues. Whereas, Reagan, everybody knows about Reaganomics. He had a big, very strong stature in the stock market for a number of years. But the takeaway is you do not want your political ideology to get too embedded in your investment plan. Because if you start playing the game of, I got to sell because of politics, generally speaking, in the long haul, you will be wrong. Now, you'd want to sell because of policy. You want to sell because of certain cyclical events perhaps happening. But based on the pure merit of political ideology, history has proven you wrong time and time and time again. And think about it. I got this thingy-majiggy sitting on my desk. See this fancy black thingy? I bet 90% of the people on this call could pull one of these out. Tana, you ever seen one of these? You happen to have one of these? Let me ask you a quiz question, Tana.
Yes.
If Vice President Biden becomes the president, do you think you will probably never buy one of these again because you live in pure fear?
No, I'm not.
Okay, weird. Okay. Do you think if Trump wins again, you will never buy one of these because of pure fear?
No.
Right. Do you think that depending on who the president is, that would deter you from going to McDonald's on November 5th and getting a cheeseburger?
No, I wouldn't pick McDonald's though.
What? See, that was very un-American of you to say.
I'm sorry.
In-N-Out burger? Would that be better? I don't know.
A little bit better.
What we have to realize is you are not investing in politics. You are investing in companies. And the question becomes, no matter who the president is, companies adapt. They have learned how to survive all presidents, all regulations, and the stock market always grinds higher. People will still go out to Target. People will still go to Walmart. People will still go to Amazon. Politics will not sway that. Now, could that dictate different sectors doing better, more or less? Maybe. Yeah. Could Vice President Biden say, hey, we want to push for Medicare for all, and that have a hampering on healthcare stocks? Yeah, possibly. Could Vice President Biden say, hey, I want to get rid of natural gas Could that have a hampering on utilities?
Mm-hmm.
Yeah, possibly. So investment allocation can be shaped by this, but saying that I don't want to be invested, I need to sell out of the stock market, I need to go hide underneath my waterbed. I don't know, do people still have waterbeds anymore?
Waterbed.
I don't know. Am I aging myself here? But the point is, people are still going to go out and do things, right? It doesn't matter who the president is. They're going to buy their iPhone. They're going to buy their cheeseburger. And so companies will always figure out how to progress. What really matters, though, is depending on who the president is, what kind of policy can shape and legislate against positive things in the stock market, regulation issues, tax issues, things that have impacts on these companies. But once again, the whole point of this chart is to show us one thing. What happens over a really long time in the stock market, Tana?
Goes up.
Goes up. The mystery continues, right? So we got to be careful about that. Now, to that point, it doesn't mean there can't be a lot of short-term volatility. Markets get volatile for a lot of reasons, oftentimes very emotional. The coronavirus is the perfect example, right? We had the worst stock market variation in a 5-week period than anybody's ever seen since the beginning of time. But we're only a matter of months away from that, and where's the stock market at? It's at all-time highs. So if we live with some kind of short-term emotional cycle in the market, it is likely that it'll cycle back up very quickly because mysteriously it always does. Long-term trends in markets are dictated on economics and the performance of an underlying stock. Short-term volatility is typically more emotional.
Yeah.
Okay, so here it is. Here's my thesis statement, right? Elections don't always impact the markets, but elections can have a huge impact on your retirement goals. Who didn't turn off their phone? See, now I'm busted. Now, this sounds a little confusing because we think about the stock market as being our retirement goal, but honestly, the stock market is a small piece of the puzzle. When I say retirement goals, I'm thinking about all the other stuff. How does your Social Security work out? How do the taxes work out? What about the inheritances you receive or the inheritances you're planning on leaving your children? Depending on the powers to be, they can really shape some of these retirement things for you. So what I'm going to do is I'm going to criticize both sides of the aisle. I think that there's some good, there's some bad, so I'm going to hassle everybody a little bit. So one of the things that the current president passed was called the Secure Act. Tana, do you know anything about the Secure Act?
Yes, actually. So if RMDs are now being pushed to someone who's age 72 instead of you're 70 and a half.
Which is probably, for most people, the visualness, the big ticket item there, right? So the Secure Act passed last year. So what Tana just said is the first obvious thing it did is instead of you having to pull a mandatory distribution off of your retirement account at 70 and a half, which, oh, by the way, what a weird rule that was anyways, they're now pushing it to 72. Now, that's kind of a funny rule for me because I sit there and I think, okay, let's think about this. Why did they do that? And they said so that way people can save more money. Okay, so what, they get to save money for a year and a half longer. And my attitude is if you're 70 and a half and saving money in an IRA for a year and a half longer is the make or break it for your retirement, guess what? You probably already had problems and it's not going to change much. Conversely, though, what it does is it plays an interesting tax game. And so what we looked at with this law, because remember, I'm about numbers, I'm about facts, I'm not here to be emotional about this stuff. So before the Secure Act, what we did is we just used some simple math calculations. So I took $1 million IRA growing at 6%, so just kind of a case study, and said, what would my mandatory distribution be by the time I got to 72 before this law was passed versus the new law? And what's interesting about it here, I just popped it up on the screen. So before the Secure Act, if I was taking mandatory distributions from 70 and a half, by the time I got to 72, my mandatory distribution is $40,800. After the Secure Act, because I'm deferring this account for a couple of years now to 72, it's almost $44,000. So what's funny is all this law did for me, when I look at it from my client planning standpoint, is it inherently made the mandatory distribution bigger. Bought you a year and a half of not taking money out, but then the distribution is bigger. And guess what? This is all taxable, people. It's taxable income. So it inherently creates more taxation too. Connor, our tax guy here in the office, he was looking at this just on face value using some tax brackets and said, hey, the before Secure Act distribution would have a $5,000 tax. The after would have a $5,700. It creates more taxation. And I thought, oh, that's kind of a funny thing. The government created what they called the most sweeping retirement plan legislation to save all people, to solve the retirement crisis kind of thing. And all it did is make mandatory distributions bigger, therefore more taxable. Geez, you remember watching Susie Orman on TV, Tana? And she would do the you'd say, hey, I want to buy a grand piano, and she'd say, show me the money, and you'd be like, all right, I got this much and that much, and then she'd be like, failed, you can't buy it, or approved. She had like the stamp on the TV. Was that CNBC? I don't remember. It's been a while, but that's kind of like that's what I need right now. Is like I would say on this one, boom, failed. I find this utterly useful to the end user. I see no value for my clients in this law. Now, the Secure Act went on further. One of the things that it eliminated was something called a stretch IRA. Mm-hmm. Tana, do you have any clue what a stretch IRA is?
Yeah, so previous stretch IRAs, you were able to inherit an IRA and then take out the distributions over your lifetime. And now it's required that the maximum of 10 years, you have to take all the money out.
Right, totally right. So what happened was when you used to inherit your mommy's IRA, you could recalculate those mandatory distributions to your own age. So they're these small distributions, and you could take them over your whole lifetime. You were stretching them over your own lifetime, hence the stretch IRA. The government put the kibosh on that very cool strategy of when Tana inherits her parents' IRA, when I inherit my parents' IRA kind of stuff, and says, no, the longest you have is 10 years to distribute all of the money. So what I did here in the lower part of the screen is I did a little case study. I said, hey, what if your 50-year-old kid inherits your big fat $1 million IRA growing at 6%? What would happen? And so before the Secure Act, over the next 10 years, your adorable child would be forced to take almost $400,000 in distributions. Whereas after the Secure Act, this money has been growing, right, at 6% a year. They would have taken $1.7 million in forced distributions. You take a lot more distributions. Guess what more distributions equal? Starts with a T.
More taxes.
With axes. So what is your ending account value in this scenario? So with a stretch IRA, the projection still had $1.2 million in the account value. But after the Secure Act, guess what? Bad news, party poopers. There is no account value. The government has mandated this thing all being forced into cash, all the taxes paid. And here's the best part of the show. Under the stretch IRA previous law, this individual would have paid about $100,000 in taxes on those distributions. Whereas because the government forced out all of the money in the account, it creates over $500,000 in federal taxes due over a 10-year period.
That's a big difference.
I would say so. So this is like a punch in the tummy when it comes to middle class wealth preservation, right? Yeah. You know, because that's what a lot of these assets are about is, you know, my kids get my money, they can then use it for their own retirement plans, but not necessarily. The government is mandating that the taxation happens, they're mandating the tax due, and it can really damage you. So going back to my Susie Orman thing, boom, failed. I could have made that on these PowerPoints. I should have.
You should have.
This hindsight planning.
Big red fail.
Honestly, this is a new law that got passed last year. I am in no way personally a fan of it on any level. So, feel free to give me your opinion on why it's a good thing, except for the fact that the government gets more tax revenue, which I guess is a positive for the government, but not for your small accounts. Okay. So then the next thing that happened in 2017, the government passed the Tax Cut and Job Act. Now, Tana, have you heard anything about this?
Yes.
What have you heard?
Yeah, well.
What's the word on the street here?
Yeah, but I mean, mostly affecting the ultra rich.
Well, what was that? You kind of cut out there. I couldn't hear you very well.
Mostly affecting those that are very wealthy.
Oh, well, yeah. So the headline you're probably referencing is like, all I heard was this is just tax cuts for a bunch of rich people. Yeah, I've heard that one too. In fact, that's like all I ever hear normally when you read about it and hear about it on the news. And so it's kind of fascinating because remember, what is Tana and my job? Our job is to understand the facts, the numbers, the data so that we can give you unbiased, informed information. So one of the things that happened was you kind of see here in the middle of the screen, the main middle tax brackets, which is the middle class, it's not the rich, they got the biggest tax deductions on the brackets. They shaved 3 to 4% off those tax brackets. So that was favorable on face value. The problem though is most people say, I didn't get a tax deduction. It didn't make any sense. It didn't affect me. So what we did is we laid out the numbers. And so what you see here on this page is what I did is I did a single taxpayer. And on the left side of the screen, I start with 2017, 2018. And I say, what if a single individual made $60,000? I applied the standard deductions based on the tax laws. We looked at taxable income, and then we looked at what was the taxation. So if a single individual made 60 grand, their federal tax due in 2017 was 7,700. In 2018, it was 6 grand. That's a pretty big difference, you know. What we see here is actually their taxes, in fact, went down, which once again, 60,000 would not be considered uber rich in my opinion. I did the same math on a single person making 120 grand on the right side of the screen. You kind of see same exercise. In 2017, pre-tax cuts, 23,000 of tax was due, and then it was 19,000. So either way, you know, 2000. Let's see, on the $60,000 person, they save $1,600. On the $120,000 person, they save $3,400. So we have this 3% tax savings. That's real money in people's pockets. See, what was confusing was most people got a tax cut. CNBC had done a study on this, and it was something amazing. Like, you know, only like 30% of people felt they got a tax cut, where 80% of people did. And what happened was when the government changed all the tax laws, they changed the withholding amounts. And they did it in the beginning of 2018 in February. And so most people got little tiny raises. You got an extra $50 per paycheck that you didn't maybe necessarily notice because it was a smaller amount. And then at the end of the year, because the withholdings were different, maybe you didn't see as big of a refund. So you thought you didn't benefit from it. But most middle class, low income people did in fact benefit material. I mean, here are the numbers. This is not creative science. These are the facts. If you then had dependents, children, things like that, you could actually pay no tax. For example, if you made $60,000, you were married, filed jointly, you had 2 children, you in fact paid 0 taxes. You actually got some money back based on those child tax credits. So, the tax brackets worked on that level. But more interestingly, let's go back to this idea of, well, what about tax revenue? Because what are we talking about here? We just talked about people got tax cuts, right? We just talked about individuals' taxes went down on average, right? But here's fun fact. So this chart shows IRS tax revenue. And so what I did is I went onto the IRS website. I pulled up 2017, 18, 19. I can show you on the website anybody who wants to see this stuff. But you know what's fun fact? 2019 was the largest one-year IRS revenue collection ever. They collected almost $3.6 trillion in tax revenue. Now, what did you say, Tana? Oh, the tax cuts were only for rich people, right? So half the country pays no taxes, more or less. I think it was 47% last time I checked. According to the rhetoric on these legislations, the rest of the people, the rich people of sorts, got these big tax cuts. And so it starts right here. So the middle line is corporate tax revenue. So you kind of see what happened, Tana, between 2017 and 2018 with corporate tax revenue. Did it go up or down?
Went down.
It went down. It went down a lot, let's be fair. And granted, even in 2019, it went back up from 18, but it's still down a lot from 2017. So that's where that rhetoric comes from is, look, the corporate tax rate in 2017 was 35%. The administration cut it down to 21%. So we saw this massive reduction in corporate tax revenue. Hence a lot of the criticism. Corporations are paying less tax. It's just tax cuts for rich people, you know, whatever you want to say about it. It's totally true, technically. Revenue did go down. The next line, though, the third line down, starts with the word FICA. FICA is employer-paid payroll taxes for the most part. And so you notice something that when you look at those tax years, guess what happened between 2017 and 2019? Employer-paid payroll taxes skyrocketed. It's up almost $100 billion. I mean, it's kind of incredible. You say, well, wait a second. What's happening here? Corporations got a big tax reduction in 18 and 19. They turned around and hired a bunch of people and paid more payroll tax. That even happened here in my little microcosm of the Lynn Group. We ended up hiring someone new in 2018. And even though my taxes went down from 17 personally on my corporation or my business, I now pay more payroll tax. And because I'm paying more people higher amounts on payroll, the top line individual income tax for the people that pay income taxes inherently went up. And so to me, it's kind of fascinating because all of the criticism that these tax cuts have gotten have actually led to a very large windfall in IRS federal tax revenue collected. In fact, it's up $150 billion in the last 2 years since these tax cuts went into place. Now remember, let's use common sense for 2 seconds. We cut taxes in 17. How the heck could our revenue be up so significantly 2 years later? To me, I find the tax cuts highly effective. You know, and like I said, I realize that these things get a lot of flack in the headlines. Everybody criticizes them. Nobody likes them. But I doubt that any of you have ever gone to the IRS website and really looked at the numbers. And the reality is our federal tax revenue is increasing. And a lot of it has to do with the fact that we cut those corporate tax rates and allowed them to turn out and hire more people, hence creating more individual income tax and creating more payroll tax. So, hey, I would challenge anybody watching this to, you know, kind of rebuttal to me how these tax cuts were a bad deal. So I didn't like the Secure Act, right? I'm being honest about that, but I'm going to give the big stamp of approval on this. Boom. I think these 2017 tax cuts were highly effective in the sense of creating more tax revenue. I don't know. Unless you disagree, Tana, you can disagree.
No, I totally agree.
I don't want to cut you out. You rebuttal it. Let's have a debate. You take the side of telling me how terrible these are.
No, I have no argument.
I got the easy side. So yeah, that wasn't fair. That wasn't fair. All right, so that kind of gives, you know, a little bit of context on things that are currently going on that do impact people, right? You know, we want the tax policies to help us out. Like I said, the Secure Act, I'm not a fan of because I felt that did your retirement plans no favors. It hassles your kids' inheritances, you know, with the stretch IRA, things like that. But what's on the ballot here, right? So there's a lot of tax proposals. See, it's interesting. We turn on the news and there's a lot of rhetoric about the people running for president, the current president, all of the things going on. But what I find fascinating is nobody is really actively talking about the underlying things that, in my opinion, will really have an impact on most people. And so there's a lot of tax proposals that Vice President Biden has proposed. I have the URL at the bottom of the screen, so you can go to taxfoundation.org and you can read about all of these things. They've gone in and they've scored, you know, what the impact on GDP is from these proposals, how many jobs will potentially be lost from these proposals. So there's a lot of good objective information there. So step one, Vice President Biden has proposed to unwind some of the 2017 tax cuts. I'd say the biggest component to me is he would like to raise corporate tax rate back to 28%. So remember, it was at 35, it went to 21, he's talking about bringing it back to 28. So not that I think that this is good. I mean, taxfoundation.org scores this thing saying that would decline GDP by 1.5% over the next decade and cost 600,000 or 700,000 jobs. Because it's inherently simple, right? If you raise someone's taxes, like even myself, I might say, oh my gosh, you know, maybe we can't afford to pay Tana anymore. And so I have to get up earlier. I apologize, Tana. I forgot you were here. I can't afford not to pay Tana is the real question, or the real point. But that's kind of the thing is anytime you raise taxes on an institution, this could impact their ability to hire. This can impact their ability to expand. It would impact their ability to have research and development and come up with new products and things because they're dealing with tax liability. In Vice President Biden's defense, though, he's only raising it back to 28%. Going back to 35, I would say would be very counterproductive. Going back to 28%, I might not love that, but that's better than 35%. So at least it's better than nothing from where we were prior to 2017. Vice President Biden has proposed for high income tax bracket individuals of getting rid of the long-term capital gains rate. That kind of like, I almost connotated that, Tana, to sound like a good thing. Like, oh yeah, he's getting rid of it. Woo-hoo. That's actually a terrible thing, which we'll talk about in a second, at least if you're in that tax bracket. The other thing that he's talking about is eliminating stepped up in basis for inherited assets. Tana, what the heck is stepped up basis?
Oh, yes. So say, for instance, if me and my siblings inherit my parents' home,
right?
Then the cost basis would be based off of or stepped up to the full market value rather than what they paid for it 45 years ago.
Okay, so that's a very interesting one. So stepped up basis is when mommy dies and you get her house, you get it at its current value versus what she paid for it a long time ago. Hence, you get it tax-free and don't owe any tax on it. What's a fun fact is that this law has been around for decades. Everybody that I know has benefited from it. This also applies to non-retirement stocks and some other assets. But the easy takeaway is we always think about real estate when we deal with this. But what I thought was fascinating about this piece of legislation is normally taxes are due when you sell something. If you sell that highly appreciated stock or that house that appreciated for a lot, normally the tax is due then. In this situation, the tax is due at death. So if you get your parents' house that they paid nothing for it and it's worth a lot of money, but let's say the market is down or you can't sell the house for XYZ reasons, and I don't know what, maybe you have a safety issue and you got to get electrical work on it, whatever the thing was, I don't know. The taxes are due at their death essentially instead of when you sell the piece of real estate. And that sounds a little challenging because what if you can't sell it? And like most people who keep most of their wealth inside their real estate, that could be problematic.
Right.
So we're going to talk about that. Okay, so let's start with this long-term capital gains thing. So if you own an investment, a stock or a piece of real estate for over a year, they have some, we'll say, more favorable tax brackets than ordinary income rates. If you're a high income earner, the max long-term capital gains rate is 20%. And a number of years ago, there was what we call a surcharge tax put on top of that of 3.8%. It is a net investment income tax. Essentially, it was designed to cover Obamacare expenses. So if you're in the top capital gains bracket, your current tax rate is 23.8%. Now that's for the feds, for the IRS. This would not include any state tax you owe on your investments, which you would inherently owe. So this is just the IRS side of it. Vice President Biden has said for those high income earners, he would no longer like to use capital gains rate. He would like to go back to the max individual tax rate of 37%, but then increase that back to 39.6% and still add on the 3.8% net investment income tax. So if this piece of legislation was to be passed, the proposed max capital gains rate would be 43.4%. I don't know about you, Tana. Going from 23 to 43?
That's a big jump.
It seems like doubling, basically. You know, I mean, that's like, bam, bam, punch you in the nose. Remember, this doesn't even count California taxes. So if you had another 10% due in California, you could easily be paying over 50% on a stock gain you had. I mean, or your piece of real estate, you know, that rental property that you had. I mean, this is massive. You know, that's I could swallow it if it was going from like 23.8 to 27.9, you know, something like, okay, but to more or less double the rate, this is impressively scary. This will shape people's decisions on if they should sell investments. I mean, what if you have a piece of real estate or rental property you've had for years, and all of a sudden you decide you want to leave the area, or you decide that rentals aren't for you or whatever because you're cognitively declining? But if you sell that rental, whatever the gain is on it, you have to pay 50% to the government now. Maybe you'd think twice about selling it. And I mean, this is very problematic. I mean, this is an incredibly large tax, more so than the way things were taxed previously. So something very interesting to be considerate of. Okay, stepped up basis. Tana explained this a second ago. Basically says when you inherit your parents' house as the example, you get it at current market value versus what they paid for it. Now, some people would say, well, wait a second, what's wrong with paying the tax on it? Maybe that is fair. So stepped up basis has been around for decades. The reason that it is here is really to avoid a double taxation. So there's another tax based on inheritances called the estate tax, or the death tax is what it's coined in the news. Essentially says is if you have a certain amount of assets, whatever over that limit is, you have to give 40% of your assets to the government as a flat tax on it. So in order to avoid a double taxation, because if you were taxed on the gain of your asset and then you were subject to that estate tax, bada bing, bada boom, man, you could lose, 80% of the value of your asset doing that. So it's painful. So here's an example. So left side of the screen, it says current law. So here's my example. And this is actually some people we know down in the Keys here in Ventura. And so it's a good example to use because I always use my human case studies. So I know someone that paid $100 grand for a house down there. You think they bought it recently?
No.
They've had it for a while. And I will tell you another thing. The majority of their worth at this point in their life is in their piece of real estate here, as is for most middle-class people. So when they pass away, their children will inherit it at its current value, which is around $1 million. Obviously, I'm using nice round numbers here. If the kids immediately turn around and sell it for $1 million, the taxable gain is zero, meaning how much did they pay in taxes, Tana?
Zero.
Zero. So mom and dad paid $100 grand for a house a long time ago. It's worth $1 million. The kids get it at their death. They sell it. They owe no taxes. They could owe estate taxes if they had other assets and were subject to an estate tax of 40%. The tax proposal, getting rid of stepped up basis. What would that look like? Same exercise. Mom and dad bought a house a long time ago. So now we're going down the right side of the screen here. They paid $100 grand. When they pass away, though, the kids now inherited at $100,000 instead of its current value of $1 million. Mm-hmm. Meaning if they sell it for $1 million, simple math here, right? They have a taxable gain of $900,000. Well, guess what? When you apply that higher long-term capital gains rate and the way this stuff works, these people in this scenario would be looking at about a $400,000 tax on this asset that didn't exist before.
Yeah.
I mean, I don't know about you, but to go from 0 to 400,000, that's a pretty big lurch when we're dealing with inheritances. And even to the point, this isn't even dealing with the estate tax. If you were subject to an estate tax, there would be another $400,000 off the top of this property because it's $1 million property. Granted, estate tax laws are very favorable at the moment, so I'm not even going to get carried away explaining that. But this is really problematic. I was thinking about this in my own situation, about this tax. So I've got 4 kids. So I said, well, okay, what would happen if I had $1 million house in this example? Well, $1 million divided by 4, each one of my children gets $250,000. Quiz question, Tana. Does getting 250 grand make you rich?
Not necessarily rich, but you could maybe pay off a house or...
Right. It's middle class wealth, right? Maybe my kids could pay off their own house. Maybe, they could save some more money for retirement. They still have to work. Their life didn't just become, gold plated. And that's kind of what a lot of these laws are about was, step up in basis. Number 1, avoided estate tax, double taxation. So that was good. But number 2, it also kept middle class people's wealth where it needed to be with the middle class. Because, the more we can pass along, the less people tend to become, we'll say, government welfare recipients. Mm-hmm. What does the proposed law say? Well, the proposed law says, I got to take 400 grand off the top to pay the tax, man. And then when I give it to my 4 kids, they each get 140 grand. My children's inheritance was reduced by almost half. To me, this is a pretty incredible law. It's a very concerning law. And a lot of it kind of starts at the top. remember, powers to be, when we look at elections, the stock market in and of itself is not highly impacted on the election happening. It takes time for the policies, processes, and procedures of the new president to, we'll say, dictate things, whether it's regulation, tax reform, that could impact the stock market. The things that I spent the second half of this conversation talking about, though, really have little to do with the stock market, right? The Stretch IRA is about taxation to your children and your loved ones. The stepped up in basis is about taxation of your assets to your loved ones. Long-term capital gains, that could have an impact on the stock market, on how people invest. But all of these things are byproducts of investing money, growing money, accumulating assets over a long period of time. And I have to admit, I find a lot of the current legislation with the long-term capital gains, and of all things, hands down, this final point I was making about stepped up basis, I find this highly concerning for the nature of what I do. Our job is to help preserve client assets, preserve their hard work, make sure that they and their family have the resources that they desire. And I'm surprised that this would be a piece of legislation that has been proposed on something that has, I'd say, been in place for so many decades. That why now? What has changed now that this would be something to attack? I find it fascinating, though, that this is not anything that's being talked about in the headlines, but truly does have an impact on my clients' individual retirement plans. So, I don't know, Tana, what else is there? I feel like,
you covered a lot.
Depressing conversation. I don't know. We appreciate you tuning in. Like I said, I'd say the takeaway from today is my personal strategy with my own assets, with my clients when they ask me, is you don't sell your assets before the election. You don't sell them after, you don't sell your investments in the stock market before the election or after it. You let nature take its course. If you start to see policies that could impact different sectors of the market, that would help you better understand how to sector rotate and consider how to invest. But remember, doesn't matter who the president is, everybody can still go to McDonald's and buy a cheeseburger. And that's all that matters is, will people still spend money? And the answer is yes. And so we appreciate you tuning in. Like I said, this was just sent to our client database for your secret eyes only. But if you want to forward it to your friends, by all means. If anybody has any questions, opinions, concerns, criticisms, curiosities, everybody's situation is different. If you would like us to calculate the tax on the inheritance for your stretch IRAs, on the tax on your inheritance for your house, on that stepped up basis stuff, because I gave you some good case study examples, but your math might be completely different. Tana and I would be very happy to show you what the math of these proposals would look like in your situation. As always, love everybody. Appreciate y'all tuning in. Hope everybody has a great rest of their day.